Yes! Perfect entry! Come on, confirm the signal! Execute now!
Most traders think success comes from finding the perfect entry.
Perfect entry! Yes! Oh no! It's crashing! What do I do? Sell, no, buy! Ow! Help! Market's going crazy!
But millionaire traders, they obsess over something else: risk. Because the market doesn't care how smart you are. It only cares about how much you're willing to lose. Today, we're uncovering the 5 risk models millionaire traders actually use through a short story of 2 traders, Mr. Wick and Mr. John. One protects his capital, the other learns the hard way.
The market's breaking down! FOMO!
John, stick to the plan. Risk management.
But Wick, we're down 30!
Patience.
Wick, look at this stock. It's breaking out. I'm putting 50% of my account on this trade. Hey, come on.
That's because the market tricked you.
Wick, look at the stock. It's breaking out. You didn't lose because the market tricked you. You lost because you risked too much.
This is the first mistake retail traders make. Millionaire traders never ask, how much can I make? They ask, how much am I willing to lose? And that leads to the first risk model. The 1% rule is the most famous risk model in professional trading. It's simple. Never risk more than 1% of your trading capital on a single trade. Example, account size equals $10,000. Maximum risk per trade equals $100. That means even 10 losing trades in a row only costs 10% of your account. Now watch what happens.
So you're telling me you only risk 1% per trade? Exactly. But that's so slow. Survives. Fast money disappears.
Millionaire traders don't randomly choose trade sizes. They use position sizing. Your position size depends on 2 things: account size, stop loss distance. Example, account equals $10,000. Risk per trade equals $100. If stop loss is $2 away, you buy 50 shares, because 50 times $2 equals $100 risk.
Wait, so you decide the risk first, then the trade size? Exactly. Amateurs pick the position size first. Professionals pick the risk first.
Millionaire traders protect something called maximum drawdown. That means if their account drops 10 to 20%, they stop trading immediately. Why? Because losing streaks happen, and the worst thing you can do during a losing streak is trade emotionally.
I lost 3 trades today. Maybe I should double my next trade.
That's revenge trading. The market loves traders like you.
Professional traders aim for asymmetric risk, meaning they risk $1 to make $3. This is called a 1-to-3 risk-reward ratio. That means even if they win only 40% of trades, they still make money. Example, 10 trades. Loss equals 6 trades times $100 equals negative $600. Win equals 4 trades times $300 equals positive $1,200. Profit equals $600.
So you can lose more trades and still win? Exactly. Winning isn't about being right, it's about risk structure.
Advanced traders use something called the Kelly Criterion, but the idea is simple. Increase your position size only when your edge is proven. If your strategy performs well, you increase risk slightly. If performance drops, you reduce risk. This keeps traders from blowing up during bad periods.
So the best traders are always adjusting risk? Exactly. They don't fight the market, they adapt to it.
So remember the 5 risk models millionaire traders actually use. 1. The 1% rule. 2. Position sizing. 3. Maximum drawdown limits. 4. Risk-reward ratios. 5. Adaptive risk. Kelly mindset. Most traders search for the perfect strategy, but the truth? Risk management is the real edge. Because in trading, your goal isn't just to win, it's to stay in the game long enough to win big. Trade smart, protect your capital, and remember, the market doesn't reward bravery, it rewards discipline. Sandy signing off. If you enjoyed this breakdown, hit subscribe for more hidden trading edges.